Hi, I'm Joseph Lewis with Eisler Wealth Management. Today I'm talking about a spend down strategy. Do you have a spend down strategy? What is a spend down strategy? Really, it's after you've accumulated all this wealth throughout your lifetime, your wealth, by the time you die, is going to go to one of four places. Either you're going to spend it, you're going to give it to your heirs, descendants, people that you've chosen. It's going to go to a charity, or it could go to the government. My approach as a tax accountant is to avoid at all costs. The reason I get up in the morning is to keep money away from the government. So really this discussion is going to focus on how to integrate your portfolio and your wealth planning with tax strategies. So there are four phases to the spend down. Number one is the accumulation phase, which is basically from the time you start working until you retire. Next is the blackout phase, where you have lower income. It will be between the time you retire until you start taking Social Security and you start getting your required minimum distributions. That could be, for a lot of people, around age 70. Then after the blackout phase comes your spend down phase, where you're going to enjoy the fruits of your labor and your wealth, and that will start usually around 70, and then it'll go until for the rest of your life. And then the fourth phase, the legacy phase, which is post-mortem, which focuses on the legacy that you've left with the world for the financial assets that you've accumulated over your lifetime. So, with your financial portfolio, there are two main drags on the returns. Number one, like we talked about, is the tax. Your number one expense in your life is your taxes. Maybe not in any given year, but over your lifetime, your biggest expense is your taxes. Number two is the fees that you're paying. So you want to talk to your financial advisor about making sure you're minimizing those fees. Eisler Wealth Management is actually an RIA, Registered Investment Advisory firm. We have a fiduciary duty to our clients, so we can't buy and sell securities that benefit us. It's been in the news a lot recently, whether financial advisors should have a fiduciary duty or a suitability standard. The fiduciary duty requires us to have the highest standard possible for our clients and not do anything, and so we charge just a flat fee. So, and we can talk about that if you, when you come into our offices. So there are 9 phases for the accumulation phase that we talk about. Number one is start saving as much and as early as possible. You talk to your financial advisor, he should be able to set up the right percentages of your income and making sure you're putting away that money. You know the time value of money. It's powerful. Get that money put away early. Number two is building a globally diversified portfolio. About half the world's wealth is inside the United States. About half the world's wealth is outside the United States. By globally diversifying, you're protecting yourself against market swings nationally and internationally. The third phase, and this is where we spend the most time looking at, is building a customized portfolio. Just like every piece of real estate is different, every single client is different. And there's really sort of two worlds that we have to merge. One is your overall life, and the other, and all the components of your life, and the other is to look at your risk and your risk tolerance. There's 4 components to your risk tolerance. Number one is your willingness to take risk. What's your gut reaction when markets change? Number 2 is your ability to take risk. Number 3 is your need to take risk. And number 4 is your tracking error risk, which really focuses on the difference between returns from the bonds as opposed to the equity. So part of your portfolio, percentage is going to be in the bonds and a percent is going to be in the equity. What should the breakdown be? What's the percentage of each? And that's really what your portfolio is going to look like based on these two merging worlds. The other is, what does your life look like? So the approach that we take there, and you'll want to talk to your financial advisor about, is number one, what are your values? What's important to you? Number 2, what are your goals? And the most important part of your goals in your spend down strategy is, how much money do you need to live each year? Do you need $100,000, $200,000, $300,000 to live each year? That's very important. And of course, there'll be other goals mixed in there based on other needs and circumstances. The third are your relationships. Who are the people that are financially dependent on you? Usually it could be children, it could be parents, it could be other people, nieces and nephews. Number 4, we need to look at your assets. Not just your stocks and bonds and your securities holdings, but also cars, properties, jewelry, other things. 5th, we need to look at asset protection. Here we're looking at what kind of insurance do you have on things? What kind of diversifications do you have? What kind of entity structures do you have? Next, we need to look at who are your advisors. Really, your financial advisor should be your CFO, the quarterback of your advisor team. Your financial advisor should be working with your insurance agent, with your attorneys, making sure that you've got your wills and your trusts and everything else properly established. So this financial advisor really needs to have a handle on all these different pieces. Next, you want to look at what are your interests. That also can include hobbies. And really by taking an overall look at your personal life and your needs and merging that with your risk tolerance, we can develop a portfolio that's effective for you. So the next piece of your financial plan and the accumulation of the strategy, this is your fourth, is building an academically sound and tried and true portfolio. So here you're going to look at what kind of funds are we going to have. There are certain indexes that yield premiums over maybe the traditional S&P 500 or the Dow Industrial, where a lot of people focus on. For example, we talked about the international funds. We also talk about having small cap stocks. Those traditionally have yielded a small premium. So by getting an academically advised portfolio, you can get some additional premiums on your portfolio. Number 5 is accumulating growth in unrealized gains. Obviously, if you're buying and selling stocks, you could potentially be triggering tax consequences. So let that growth accumulate in unrealized gains, and maybe you'll get a step up in basis upon death. In tax planning, the step up in basis basically means that whoever inherits a stock gets it as though they had purchased it on the date of death. And so they turn around and sell it the next day. Voila, no tax consequences. The next piece is making sure you've got proper asset placement in your portfolio. Part of your portfolio should be tax deferred accounts. You might have 401ks, you might have IRAs, and some stuff that is able to defer the taxes until later, and then you'll have your taxable accounts. You're going to want in your tax deferred accounts things like fixed income, because they're generating ordinary income. These are taxed at higher rates than the dividends. When you've got your stocks that are generating dividends, those are actually taxed at capital gains rates, which are preferential rates. So you want to put those in the taxable account. The next piece, after make sure you got your proper asset placement, is make sure that the tax loss harvesting structure is in place. In other words, if you're generating income from one stock sale and you've got losses somewhere else in your portfolio, you can offset that by properly selling the stocks with the losses against the stocks with the gains in it. So the 8th part of the accumulation phase in the spend down strategy is managing who's the first to die. It's that principle we talk about where you've got step up in basis. Whoever inherits the stocks is going to get the basis of the person that died. So making sure that if you've got a married couple, the husband and wife, which one's the first to die, making sure that the highly appreciated assets are passing through the one that passes away first. And then the 9th and final piece of the accumulation phase that I talk about with clients is managing tax bracket creep. Now, with the new tax brackets, once you hit $315,000 of income, all of a sudden your tax bracket will jump from 24% up to 32%. That's pretty significant. So make sure that whatever tax bracket you're in, you're not swinging up and down, hitting high taxes, low tax, high tax, making sure that you're getting the best, most tax advantageous sale price on all of your stocks. So really managing tax bracket creep is an important part of your overall portfolio strategy. So those are the 9 parts of the accumulation phase of the spend down strategy. We'll talk about the other 3 phases in subsequent videos. If you have any questions about what we talked about today, make sure you talk to your financial advisor and that you understand the answers. You can come talk to me. I'm Joseph Lewis at Eisler Wealth Management. I'd love to have a chat with you and look forward to talking to you. Thanks.